right. Good morning, good afternoon, wherever you are. My name is David Shadle, and I am president of Shadle Financial Group here at LPL. And I'm excited to have everybody joining us, whether it's live or on the recording, for our Basics of Investing webinar. Now, I do want to preface this by saying this is designed to be 101 level education. Maybe we'll venture out into 102, but by the end of this, you're not going to be going and doing complex options trading or Forex futures or anything like that. This is designed to be just a foundational level knowledge about kind of investing and just some of the fundamentals. So as the basics. So with that, I'm going to go ahead and share my screen so that we can get started. So on today's agenda, kind of in the spirit, is we're going to cover a couple of things. So one, are you ready to invest? Number two, talking the talk. That just means getting familiar with some of the terminology associated with investing to make sure you're not talking about apples when you mean to be talking about oranges. We're also going to talk about the 4 steps to becoming an investor, which is going to be really important. And then just kind of having a conversation about what kind of investor you are or you want to be. Not everybody has the same investing philosophy or the same process for investing. So it's really important when it comes to investing, figuring out what works for you. So I think what's really important is talking about, are you ready to invest? And I apologize. I think we're a little. Are you ready to invest? So there's a couple of things that are important to make sure that you know that you're ready to invest. So these are just some foundational things that's really important to get out of the way before you start to investing in things that are going to fluctuate in value. So it's really important to have some sort of a steady income. That can mean a lot of different things to a lot of different people. You want to make sure that with that income and your expenses that you have money left over after meeting all your financial obligations. Part of that may be right-sizing your budget or increasing your income, but you want to make sure that you have excess capital to invest. You've also considered the effect of upcoming personal changes such as marriage, children, or divorce, just things that may impact your situation. That's just a small sample of some of the things that can come into play. But also, and this is really important, just making sure that you have some sort of emergency fund set up. And this is really, really important because I think an emergency fund is really the foundation of being ready to being able to invest. And what I mean by that is an emergency fund is designed to have cash on hand in case something comes up. So you're never in a position where you need to try and figure out or selling something when it's not a good time to sell something. So having the right amount of cash in an emergency fund allows the investments to do what they're going to do, which is ebb and flow a little bit with what goes on in the markets. I think that's really, really important to address. So we're going to jump back a couple of things. So I think it's also important to kind of think about what's your investing approach. So everybody can have their own investing approach. Some people like to DIY, do it yourself. And so, I want to figure it all out by myself, which is great. I do think it's important if you're going to be doing it yourself that you take the time to actually learn about what you're investing in and making sure that you continue to monitor it. I think sometimes people do a really good job of putting some time in on the front end and understanding what they are investing in, but then maybe they don't do as good of a job of keeping an eye on it, making sure that the reason they originally invested is still a good reason to continue to invest, because investing is usually 2 decisions. It's one, when to buy something, and then secondly, when to sell. And you can be a buy and hold investor, which just means you buy something and you hold it forever. But I don't think buy and hold is the right terminology. Buy and review or monitor might be a better way of saying, because I think buy and hold sometimes can get people into a little bit of a pickle. So number 2, we're going to figure out that you can talk the talk and see if you're ready to be able to invest. So I really believe that an educated investor is a good investor. And so a couple of great ways to source information would be something like the Wall Street Journal. So it's getting harder and harder to find objective news sources these days, but anything that you can do to get updates on the economy or what's going on in the market. There are a lot of things out there that do like a morning brew. In fact, the Wall Street Journal also has a really good podcast that talks about a variety of different topics, not just about investing, but about the economy as a whole. So the firm that we're affiliated with, LPL Financial, also does some weekly insights through the research department. That is probably getting into like 201 level type information, but it's really important to start reading. And as you read things, if you don't understand the topics, go Google them. Go to Investopedia, but find some good resources that allow you to kind of follow what's going along. I would also add Yahoo Finance also is a pretty good free resource. But I do think it's important to look at a variety of information sources because not everybody has the same opinion. And I think it's really important not to just to take something as gospel if you're going to be doing it yourself, but then also, having a good handle on a lot of different viewpoints so that you can come to your own educated decision. So I'm going to jump back to going back to, are you ready to invest and the types of investors. There's also, I just need a little guidance and I'm good. So these second two are probably more in the lines of the folks that we deal with. So, hey, I just need a little bit of high level guidance, or hey, here's an investment that I'm thinking about or a theme that I'm looking to play. Am I thinking about this the right way? Or is there another more efficient way that I could be approaching this investment style? And then there's nothing wrong with just saying, please, can someone take care of this for me? Now, I do say, and this is with a lot of the clients that we work with as well, is there needs to be some sort of guardrails or conversation about what to invest. So just handing the keys to somebody and saying drive it is not really great. You may want to give them a speed limit or say, hey, I'm a growth investor or I'm a conservative investor. And I think that should be a negotiated process about figuring out how much growth you should be looking for or how much stability you should be looking for. And it's really important if you are going to let someone handle it, that you have some sort of guardrails so they don't do something that you're not expecting them to do, which I think is really important. So going back to talking the talk, I think it's important for us to cover a couple of common terms. So we're going to talk about a couple of different stock markets. So the Dow is probably the oldest and maybe the best known American stock market index. So especially for older folks, they've known the Dow. They talk about the Dow quite a bit. It's a little bit outdated as far as a good way to track what's going on in the economy, but it was started back in 1896. So it has an incredible amount of historical data, and it consists of 30 high quality blue chip stocks. Now, the companies inside of that, so a couple of examples are Coca-Cola, McDonald's, and Johnson. But the 30 stocks in the Dow, and technically it's the Dow Jones Industrial Average, DJIA, but those stocks will change. Sometimes stocks are removed and replaced, but it's always 30 high quality blue chip American companies, but those 30 companies will change. And so with most indices, they'll kick people out, they'll add people. And that's important because that's a good way for it to track things. But that's what the Dow is. So the Dow, when people say it's the Dow Jones Industrial Average. Another popular stock market indice is the NASDAQ. So I think this is kind of cute. They have the pronunciation key. So NASDAQ. And this is honestly one of the first exchanges to offer online trading. So it is going to be a little bit more tech forward. And as you can see, like Apple, Facebook, Google, Amazon, most of the NASDAQ is going to be technology focused. A lot of the ticker symbols also have 4 letters in the acronym. Some other ones that are included that aren't listed here would be things like Microsoft, MSFT, and Apple's APPL. Facebook is now META for Meta. But then there's also smaller companies that are listed in there, like Angie's List, 1-800-Flowers, Starbucks. Other non-technology related companies are also a part of the NASDAQ. So, I mean, you can have bank stocks, you can have Spirit Airlines, a lot of other different things are going to be on there other than just technology companies, but it is going to be more of a growth focused index, and it is going to be more of a tech focus relative to the Dow Jones Industrial Average. But different indexes track different things, and so it's just kind of important to know a couple of those common ones. Another one that's not listed in here is the S&P 500. It's usually about 500 names. That's probably the most commonly followed stock market index. So when a lot of people talk about the quote unquote market, S&P 500, which is run by Standard & Poor's, that's what the S&P stands for, that's what they're referring to. So now we're going to pivot into the 4 steps that are required to go from a saver to an investor. And I think that that's really important. Saving is the process of taking money from your checking account and putting it somewhere else. But while that's a really important discipline to have, taking that money and putting it into something that can grow is what really takes you from being a saver to an investor, which is really, really important. So step 1 is just to learn which investments are appropriate to your financial goals. Are you saving for retirement? Are you looking to buy a new home? Are you looking to pay for a college education? Are you looking to save up for a new car? Any financial goal is important, but what you are looking for and the timeline to accomplish that goal really impacts what decisions or what investments you should be looking at to help accomplish those goals. So we're going to cover a couple of different types of investments. So the first I want to start out with is stocks. And stocks can either be owned individually, so owning a company like Coca-Cola or Apple, for example, or you can own them through another vehicle such as a mutual fund, an exchange traded fund, ETF, a unit investment trust. But at its core, when you own stock, you technically own shares of that company and you have an equity interest. Now, granted, depending on the size of the company, like Nvidia or Apple, some of the bigger ones, it may be a very small piece of the company, but you technically have an ownership interest in that company. Stocks are shouldn't say typically, they have higher risk, also the higher potential for return. So not all stocks are created equally. Apple is a lot different than a small cap technology biotech, for example. So not all stocks are created equal, but any individual stock does have the potential to go to zero. You're an equity holder, and so that investment can go to zero. I don't say that to scare you, but a company like Apple is a lot less likely to go to zero as a startup biotech company that may have their one product not approved by the FDA. So they're not all created equal, and they are more appropriate for long-term financial goals like retirement, or maybe if you have a 1-year-old that you're saving for college at 18. So stocks will do better over time, but they also have a higher probability of dropping in value. We saw a drop here recently in the stock market where it dropped 10% in a short period of time. We saw a peak to drop of 20% last year during the Liberation Day tariffs. Back in 2022, the markets dropped close to 30% and finished the year down 18 to 25%, depending on which one you're looking at. So they may not make sense for shorter term financial goals just because they do have a tendency to move around. But over time, as long as you can tolerate that volatility, stocks do typically offer the greatest potential for return. You just have to acknowledge that they're not always going to do well. They will have periods where they don't act as well. So number 2 is going to be bonds, or just like stocks, you can own bonds via mutual funds, exchange traded funds. But with bonds, a bond is basically where a company, a municipality, or a government entity is looking to finance projects or operations. So when you own a bond, you technically are lending money to whoever issued the bond, because a bond says, hey, you give us money, we will promise to pay you interest. That's the income that you receive for the bond. And we'll also promise to pay you back at some predetermined date in the future. So the principal and stated interest rate with a formal maturity date. So you usually get interest and then the bond or it gets called away. So they have moderate risk with moderate potential returns. So depending on what type of bond you own, technically that issuer, being the company, the municipality, or the government entity, they technically can go in default, which means they may not pay you your interest or they may not pay you all of your debt back. But when you are a lender, you typically have something as collateral. So if the company does go under, what would happen first is all of the stockholders, their value would be wiped away. And then next would come the senior secured creditors. So basically, what I mean by that is a bond is just much safer because even if something goes wrong with the company, you're a lot more likely to get your money back than you are as a stock investor. And bonds are probably better suited for people that need some sort of income. So maybe someone in a retirement portfolio or someone who's trying to limit portfolio volatility. Now, bonds are not without risk, they just have different risk than stocks. So there are some periods where stocks do well and bonds do poorly. There are some periods where stocks and bonds both do well, some periods where stocks do poorly and bonds do well. But bonds are another key part of the portfolio, but they're more considered for stability or income generation, which is more things as you get closer to retirement and just having a little bit more stability in there. Now, we've been kind of going in order of most risky to least risky. So the last thing that we're going to cover is just cash equivalents. So these could be money market funds, it could be savings accounts. They have little to no risk. I say little to no because technically there is risk of purchasing power. Inflation typically isn't kept up with cash equivalents, but you're typically never going to see that value change. Like a money market mutual fund is always going to be worth $1 a share. Now, technically, that's not guaranteed. There have been a couple of instances where that money market fund has not been worth $1 a share. That's very few and far between, but technically it is a risk. But they have very consistent, lower, but very consistent returns. These got really popular over the last couple of years as risk-free rates got up around 5%. We've seen since then them come down to the 3.5% range, but they're great for just liquidity needs. So I think they're more important for needs in that 3 to 6 month range or for managing distributions, but they're very, very safe. But in exchange for that, you're less likely to get good returns. So when we kind of talk about this, now granted, this data is a little bit old, but it's kind of important to look at from 1985 to 2022, and keep in mind, 2022 was a bad year for both stocks and bonds. Bonds were down about 13%, stocks were down about 18%. But when we look at the average annual return from 1985 to 2002, the S&P 500 did about 8%, bonds did about 3%, stable assets, so that would be things like cash, didn't even do 1%. They did less than 1/2 of 1%. And over that time period, inflation, as indicated by the CPI index, averaged about 2.74%. So you can see bonds kind of kept up with inflation, cash did not, and stocks actually exceeded inflation. Sorry about that. Now, if we stretch this out to the end of 2025, because 2023 was a good year for stocks and bonds, 2024 was a good year for stocks and bonds, 2025 was a good year for stocks and bonds. In fact, really, really good years. So if we added those 3 years, this return jumped from 8 to more like 11%. And bonds went more to like that 4 to 5% range. Stable assets creeped up just a little bit, but not much. So I like to tell people over time, stocks are probably going to get you somewhere in the neighborhood of 8 to 10%. I know that's a big range, but it kind of depends on what the time period looks like. Bonds probably going to be more like 4 to 6%, depending on the type of bond that you own. And then stable assets, I think over time, we're probably going to do more like 2%. But inflation, I think, is going to be consistent around 2.5%, that 2.74% range. In fact, the Federal Reserve targets a 2% inflation rate. All right. Last, but certainly not least, 4 important steps to becoming an investor and going from being a saver to an investor. So we've talked about all these different asset classes. We got stocks, we got bonds, we got cash alternatives. Diversification is basically just the concept of how much of each of those things should I have in a portfolio? And it's really important to not just balance your portfolio with different asset classes, but even different investment options from within those different asset classes. So you may have heard the saying of, hey, don't put all your eggs in one basket. This is kind of what diversification is talking about. So if you have all your eggs in one basket and there's a hole in the basket, that would be concentration. Concentration can be great if a stock does really, really well, but it can also work against you. So there's a saying in investing that concentration can create wealth, but diversification preserves it. I would add to that that diversification can help you grow. It's just going to give you a smoother path to getting that. Now, granted, you're not going to have the Nvidia or the Apples of the world where you could potentially annualize 50 or 60% with a diversified portfolio. That's just not going to happen. But even those good companies have had really significant drawdowns. And if you pick the wrong one, like an Enron or a, oh goodness, what's another one that didn't work out? Basically companies that went under that were very well. WorldCom was another one. AOL.com, really big company that went to zero. That's a really big important of why it's important, especially as you're getting started, to really leverage diversification. And even if you have a lot of different stocks, that can still be a great way of diversification. So when we talk about diversification, I think using lifesavers is a fantastic example, especially as a father to two young children. I'm very familiar with candy, especially hard candy with a hole in the middle, which is less of a choking hazard. But I digress. So Clarence Crane invented lifesavers back in 1912. And originally, he only manufactured one flavor. It was the peppermint or peppermint flavor. And in 1913, Crane was approached by Edward Noble, who suggested that if they offered different flavors, they would attract more customers. Crane honestly wasn't interested in the concept, but agreed to sell lifesavers to Noble for $2,900. Now, that was actually a lot of money back then. But during his lifetime, the purchaser, Edward Noble, went on to develop a $1 billion business by manufacturing the different flavors of lifesavers that we have all come to know and love, which is crazy. So what he did is he diversified his product line. It appealed to more people. It wasn't just that peppermint flavor. They had the peppermint, which also they added spearmint, all these other things. But they added all these other flavors. And by diversifying the product line, they were to appeal to a broader base and honestly was able to protect the business from the risk of one flavor losing popularity or just not being great. So this isn't a direct correlation of how diversification can impact investments, but it's really important to think about diversification as a tool for your investments and to help spread the risk and protect your potential rewards. And then also, if you think about stocks, they all kind of go up and down differently. So if you have a good basket of stocks, when one of those good companies has a bad quarter, if you own, let's say, 30 stocks instead of one, you're not going to feel it as much because the other 29 stocks in the portfolio may be doing really, really well. Because even really good companies have bad quarters and bad years, even if you're going to plan to hopefully own that investment for 5, 10, 30 years in the future. So another step is, and I kind of alluded to this a little bit earlier, but understanding how the economy impacts your portfolio. So even great companies can be impacted by external forces. So, a little economics 101 lesson for you is just to understand how what's going on in the economy and how a country uses its money and resources to produce goods and services greatly impacts stock market activity. So, for example, like whether the economy is growing, shrinking, or standing still will have a byproduct on how investors view stocks in their portfolio. So, understanding the impact of the economy can help you better understand the ebbs and flows and doesn't make it any easier when we see our portfolios drop in value. But as long as we understand why and some potential resolutions on how that's going to go away, I think it's a lot easier to kind of stay the course during difficult times. So I got this bull and this bear. So the reason this is important is a bull market is when stocks are going up and investors' confidence is high in stocks, which typically means that stocks trade at a higher valuation because people are more optimistic. And then a bear market is when investors are more nervous and stock prices typically decrease. So interesting fact, a bull market has its name because a bull attacks with its horns upwards. A bear takes its claws and it swipes down. So the bull market is because a bull attacks upward, and a bear market is named because a bear attacks downwards by swiping its claws down. So, even good companies during a bear market can offer really attractive valuations because the stock price goes down because not of anything going on fundamentally wrong with the company, but just because maybe we're in a recession and people have had to sell stocks or people are concerned about the future opportunities of a company. So bear markets can create really good buying opportunities if stocks are undervalued, whereas a bull market can also present buying opportunities, but it's really difficult because psychologically, as humans, we are wired to want to buy things as they go up and sell things as they go down. And that's not always the best thing to do as an investor. All right. So the last thing I want to talk about, or I shouldn't say last, one of the last important things is inflation. So historically, cost of stuff always goes up. I mean, that's a fact. We've experienced that more so recently than we have over the last 20 years. But stuff goes up. Sometimes it goes up faster, sometimes it goes up lower, and low inflation is usually a good thing. High inflation, as we've experienced over the last couple of years, can be bad. It says potentially bad, but high inflation is usually not a great thing. So we want controlled inflation that is good for our economy. We don't want deflation. We don't want stagflation. We don't want high inflation, but a healthy level of inflation is very good. And inflation is a really important reason on why you should invest because, like I said before, keeping your money in a savings or a checking account as inflation goes up, meaning it's more expensive to buy the same thing today as it was 5 years ago. If your money is not growing to keep up with that, you are losing purchasing power. And even though your cash may not have dropped in value, it has lost its ability to buy the same amount of the same thing. So hopefully that makes sense. So inflation and interest rates are related to each other. So certain interest rates are influenced by the Federal Reserve. So short-term interest rates are directly controlled by the Federal Reserve. Longer-term interest rates, so things that like mortgage rates, car loan rates, those are more closely tied to what goes on in the bond market. But just speaking specifically about what goes on with the Federal Reserve is as rates go up, stock prices typically tend to go down. Now, that's not always true, but when rates goes up, it's usually because they're trying to battle and control inflation or trying to do other things. They're trying to cool the economy down. So that's usually not a great thing for stocks. But when rates go down, typically that benefits stocks. Now, that is a very broad overgeneralization. Certain stocks can actually do better, but generally speaking, that is true for stocks. So the last thing is just seek guidance if you need it. That could be, working with someone like us. This is just some of the things that an LPL financial professional like ourselves can help you with. And it's not just about investing, it's helping you figure out what your important goals are or how to best go about accomplishing those goals. And I think it's really important not to just work with a investment advisor, but to really work with a financial planner or financial advisor that is going to ask the right questions to really get a good sense of what is important to you, because how they invest your money is a direct byproduct of your unique situation and needs. And I think it's really important to either work with a professional or just reflect internally and have very honest conversations about what you need and the best way to accomplish that. All right, skip through some of this stuff. So here's my contact information. Quick little disclaimer, this was created for educational information purposes and is not intended as ERISA, tax, legal, or investment advice. Again, if you're seeking investment advice specific to your needs, such advice services must be obtained on your own separate from this educational presentation. So with that, I think we kept it right in time. I want to thank everybody for joining us today. If you attended live, if you're watching the replay of this, thank you for spending your precious time learning about the basics of investing. If there's anything that we can do to assist, please reach out. If you're looking at this on the YouTube channel, our contact information is there. If you registered, you'll be getting a replay of this and you'll also have our contact information. So hopefully you found this helpful. And if there's anything that we can do to assist, we would love to be a resource. Thanks so much for attending.